Welcome, everyone. Everyone, welcome to the Benzinga Cannabis Capital Conference. You guys excited? Everyone, if you're in the back, come take a seat. We want to kick this off. We're 3 minutes behind, and we keep our conferences quick, fast, efficient, so you guys can network, learn, and make money. This event is about deal making. We do this event, this is our first time bringing it to the windy city of Chicago, Toronto, Miami, Detroit. We are about making connections for investors, companies, service providers. You have over 850 vetted people in this room. We put these people in this room so you guys can connect. One of the house rules that we have, you'll see it on some of the signs, is sit next to someone you don't know. And it says, no, seriously, party rule. The reason is, it is really easy to hang out with the people you know, but you're here for 2 days. You can relax, you can network, but make yourself go meet someone, be uncomfortable. What happens when that happens is so much success. We don't know exactly what's been raised through our event. We think over $1 billion, actually $2 billion, through connections that's been happening over the last 5 years. We started with Alan Brockstein, a 420 investor, who we partner on this event, and it's been an unbelievable relationship. And then New Frontier Data underwrites the event, and they help us put this thing on so you guys can come here and network. We have people from Colombia, from 46 states, and it's not just like the same people you're going to see at every other event. We literally go and we fish. We try to find investors that never come to events. We have an investor that did his first investment. They have a $100 million fund. No one knows this guy even exists. He'll be here tomorrow. He invested $20 million in his first deal 2 weeks ago. It was in the paper. But you'll see him tomorrow, and it'll be a little bit surprised. So we really, really focus on inviting people that can be strategic to your business. So events like this are what you make of it. So it's very easy to sit back, go to sleep at 8 o'clock, not network, not go meet the movers and shakers, but then you go home and you have nothing to come from it. Our whole point of this event is you meet people, you connect, you make relationships. Again, sit next to people that you don't know, because you never know what these relationships are going to bring tomorrow. And there's a couple other things I wanted to mention, the countries that we have people who've traveled. So Colombia, Israel, Canada, Mexico, and what was it? Okay, and then 2 more things. So this event, it's action-packed. We have an exhibitor hall down below that you can, in the front area, you'll see the different exhibits. There's private networking in the back area, and that's where companies have their things located. Tomorrow morning, if you get down here about 8:30, 8:15, at about 8:45, 8:50, we have speed networking, where we arrange, it's 5-minute meetings. It's a chance for you to meet other companies, other investors, and connect. Again, this is about making connections and getting the education and learning who these people are moving and shaking in this industry, because there's a lot of them. And one of them I'm super excited to introduce. It's a good friend of mine who I met at an event like this by sitting next to someone I didn't know. And this lady has been moving and shaking for I don't know how long, but in the last month and a half, she's done in the last month and a half what some of us do in like 10 years. It's kind of, I don't even know how she's even here and walking, but like they're an important part of this Benzinga Cannabis Capital Conference, New Frontier Data. They've been our underwriter since we started this, and I want to introduce the awesome Giada Aguirre de Carcer.
Hi everyone, good morning. First of all, excited to be in Chicago. I'm a big fan. Super excited to be here with the Benzinga team. New Frontier Data, we like to be at the forefront of things. We like to partner with companies that have vision and sort of are driving. And so we cannot be happier to have partnered with, indeed, Benzinga since they started. So big applause for a well-run event. They do a very good job. So thank you.
It's taking me easy.
And going along that forefront, A lot of investors here, making connections, figuring out where the next opportunity is. Since 2014, we've been very fortunate to help investor and financial institutions identify that new opportunity while understanding the challenges in order to navigate and mitigate. Well, as we continue to look at market trends and what the future may bring us, about 18 months ago, we realized that there was a whole new set of enterprises and interest that was coming into the industry, beyond tobacco, alcohol, and pharmaceutical. And that's CPGs, consumer packaged goods. Very large multinational enterprises. I will name some names that I'm just naming for illustrative purposes. My attorney told me to say that. The Nestle's, the Coca-Colas, the Procter & Gamble's, the Johnson & Johnson's. They're looking on how to connect with the cannabis consumer. They want to understand, what is this 344 billion sort of illicit and legal, consumption? Like, how do we get in there? And so as New Frontier Data is a big data company, and we sort of, we tend to connect with those companies outside of the space coming in, we started getting some calls about, well, can you help us navigate sort of this engagement to the cannabis consumer? And we realized that there were some gaps there, and that we didn't have everything we needed in order to meet that demand. And so Jason mentioned, we did announce 2 acquisitions this week, and those acquisitions were, for us, which we worked on for 18 months, not just the past few months. I wish I was that good. It's been almost 2 years worth of work. But the idea was to sort of begin to help this large group of deep pockets, mind you, that are coming in to bring in more sophisticated solutions and marketing and advertising, coming in and engage with the cannabis consumer. Huge opportunity for you as investors, and for us, huge opportunity as revenue generation. And we like to call that the Next Frontier Solutions. So very excited to formally introduce the Next Frontier Solutions here at Benzinga today. One of our partners here is Zephyr, so I encourage you to talk to them. And if you want to learn more about what is this wave of new enterprises coming in and what it means to you, please come find us and attend Gary Allen's talk. So anyway, welcome and enjoy the show. Thank you very much.
So our next guests are 2 people that have been moving and shaking in this cannabis industry. You've been you see one guy on CNBC a lot, and he's been doing stuff in the space for years. And you guys know him as Tim Seymour, and he's doing a fireside chat with a person named Jason Wild, who has been prolific in the space. He got in early, and Bruce Linton once told me he's one of the smartest guys he's met in the space. And so Jason Wild, who's a Wisconsin Badger, so don't talk about the Illinois game to him. Without further ado, I want to introduce Jason and Tim.
Good morning. Obviously, I am no Jason or Tim, but my name is Kevin Irwin II. So how are you today? We need to feel the energy. Today is one of the most impactful conferences that anyone in this space has ever attended. Are you ready? And it looks like our guys are ready too. So please make some noise as we welcome to the stage Tim and my guy Jason.
Thank you. Thank you. Wow, this is like 4:59 or 5:01 on every weekday on Fast Money when I walk in just before the bell or after the bell, and people wonder, where were you at your call time? Right. So, apologies. We were having a great conversation out in the hallway. You wouldn't believe the things that are going out in the hallway out there. So, anyway, good morning, and it's a pleasure to be here at another Benzinga event. These guys have done a fantastic job of, I think, keeping the investor community and the institutional community very informed on cannabis. And part of what we're here to talk about is a little bit on the traditional institutional investing side. And I'm going to introduce Jason here in a second. But based upon the way the industry has evolved, the role of the institutional investor is something that I think has largely been missing, and I think this is something we want to talk about. So without further ado, I want to introduce Jason Wild, who's President, CIO of JW Asset Management, a firm that's been investing in the cannabis space from the early days. He also wears another hat, which is chairman of TerraSend, which is a large North American operator, which many of you know probably quite a bit about. So he's got an interesting duality in terms of how he's looking at the market. For those that don't know me, again, my name's Tim Seymour. I am a investor in the cannabis space from the early days. I'm an emerging markets guy, so this whole new asset class thing makes a lot of sense to me. I'm actually a portfolio manager for an ETF I launched a couple months ago, ticker CNBS. It's a cannabis dedicated ETF. But Jason and I are working on a dedicated hedge fund, which is an extension of what he's been doing for the last 20 years. And I think we're here to talk about that. So Jason, quick introduction. Nice to have you here.
Yes, thank you. Thanks for having me.
For people that don't know your background, just, let's frame, I think we're down to 13 minutes here. So the wonderful thing about Benzinga is they keep it moving. Let's keep it moving, but it's important for people to know your background. You're a pharmacist. You've been running an asset management firm that's now over $1 billion. So it makes you one of the largest, if not the largest institution in the space. You've annualized at 26%, so you're doing something right. Why cannabis, and where'd you come from?
Sure. So I'm originally a pharmacist, as you mentioned, Tim. Started a fund in 1998 with $80,000 under management. My view was sort of, if you build it, they will come. I felt like I was a good stock picker. So eventually, if we had an audited track record, eventually we'd be able to raise money. First 12 years, we did all public equities in pharmaceutical stocks. But in 2010, we bought a small drug company to use as a platform to build it into a larger company. That company was called Arbor Pharmaceuticals, and that worked out really well. We bought it in 2010 for $2.5 million. We built it into a substantial company with over $100 million in EBITDA. About 3.5 years later, we sold a third of that to KKR at a $1.12 billion valuation. Right around that time is when I got a call from a banker up in Canada raising money for a company called Metrum that had one of these new medical marijuana licenses. Went up there. Learned all about the whole cannabis, the way the stigma was changing, all the medical uses for cannabis. First time I had ever heard of CBD. This was middle of 2014. Okay. And I sort of just decided I wanted that there was a huge opportunity in this space. It was really, I considered it, and I consider it pharmaceuticals. It's just, in my mind, the only part of pharma that's going to grow significantly over the next 20 years.
What were your investors saying to you? You had obviously done right by them through a couple major acquisitions, but I mean, cannabis was not what everyone was doing in 2014.
Yeah, fortunately, pretty much all of my investors are high net worths and I had built up enough goodwill with them because they had made decent money with me. So we didn't really get any pushback. In fact, even till today, high net worths are, when we talk about cannabis, they're very positive on cannabis. Right. Institutional investors are less likely. Institutional investors still, well, maybe a little less so in the last few months. But institutional investors, I think the reason they're less likely to invest, or they have been, is more because they're worried about their endowments that are invested with them and things like that. But high net worths, when we tell investors what we're doing in the space, they absolutely love it. So what happened was back in 2014, I set out to meet as many companies as I could, met about 25 companies that first year. We invested in 5 of them, and fortunately, those 5 became some of the leaders in the space. Metrum was bought by Canopy Growth for all stock. We held on to the majority of that position for the next several years. We're also large shareholders in Organogram, and we were large shareholders in Kronos, and a few other names. So started investing in 2014. By the end of 2017, we had put about $25 million into the space, and it was worth about $200 million. And that was when it sort of hit me that the same thing that happened in pharma just happened in cannabis for me. In the first 12 years in pharma, I invested in non-control positions in the pharmaceutical space, learned the space, built a network, made some money, and with Arbor, my goal was to bring all that to bear in something that I could have more control over the result as the chairman and the lead investor. And I realized that in the cannabis space, about 3 or 4 years in, the same first part just happened where we had invested in cannabis, learned the space, made some money, built up a good network. The only difference is we became pretty much the largest institutional investor in the space. So we were seeing this amazing deal flow, and I felt like there was a good opportunity to go out and start our own cannabis company.
So this is interesting. So and TerraSend is born, and obviously the confluence of just being an institutional investor where deal flow comes to you, having built a significant sized pharma company. How do you juggle your CIO hat versus your chairman's hat? And let's talk about why this is a benefit, because ultimately I know you see it as such, not only for the deal flow you can see, but for your investors in a world where with enough disclosure, understanding where conflicts might actually not be such, and understanding where actually investing alongside TerraSend might be part of what we think is good for investors.
Yeah, absolutely. So I've always run my fund more like a family office. I've spent very little time trying to raise money. I would always rather focus on finding new companies to invest in or talk to the companies we're already invested in. So I've always owned between 45 and 50% of the money in the fund is my money. So I look at it, I'm eating my own cooking. And I look at, and the fund, a large percentage of the fund is invested in TerraSend, obviously. So when we have deal flow come through our offices, my view is generally that if that company, if I like the company and I think it could be a good fit with TerraSend, and that company thinks that they could be a good fit with TerraSend, I would rather refer them over to TerraSend and have them be part of that whole platform, because I think we're going to build more value, not only for TerraSend, but for the investors in my fund and me as an investor in my fund. So I see it as a sort of a positive conflict that a lot of companies start out coming through my doors just wanting me to invest a few $1 million in a non-control investment. And if we really like it, I'm usually able to convince them to potentially come over and be part of TerraSend. And I think that that's a win-win. It's a win for my investors, because we're going to get a lot more value out of that asset as part of this overall platform.
They also tell me to put my ringer off when I'm on TV, so I should probably have done that here too.
That's probably my wife. She would say that the problem with me wearing two hats is that I'm not home enough.
Apparently, I'm getting a refrigerator delivered in New York today. Thank you.
So anyway, I think we see as many deals as anybody coming through our doors. A lot of them I refer over to TerraSend, and then a lot of them are not necessarily a fit for TerraSend, and we invest in them directly.
So that brings us to me where I think we can get a little bit into both investing and the focus and how we see deal flow, and also a little bit about brands. Everybody talks about brands in this industry. Now, TerraSend bought a group called Apothecarium, which is arguably one of the most highly decorated dispensaries in California, and also in Nevada. Talk about brands through the eyes also of one of your strategic partners, and how you see it as an investor in both. Everybody claims they've got a brand today, and I think there's a lot of people and a lot of investors get very uncomfortable overpaying for a brand in the environment we're in.
Yeah, so it's interesting. A lot of people are obviously talking about brands, and when they're talking about brands, they mean product brands, different formulations and things like that. My view is that the dispensary brands are the brands that we really want to go after. The Apothecarium is a good example, and the Apothecarium stores are, to me, the nicest stores in California and Nevada. But I also love the name. I'm a pharmacist and the son of a pharmacist, and the Apothecarium is just a name that has made my father proud in terms of.
That's important.
Yeah, it straddles medical and rec really well, and they've just done a great job in terms of really building long-term value by focusing on their customers.
Is that your channel check, though? I mean, can you look at companies that come into your offices and say, hey, we're this, we're that, and run it straight through Apothecarium to see where they are on that brand?
Absolutely, and I'll run a lot of the ideas of the different California brands by the Apothecarium folks, and they're pretty. Right. I like to joke that they're a little snobby, being a premier San Francisco dispensary. But hold
on a second, San Francisco less snobby? I mean, sorry, San Fran.
But generally, my view overall on brands in terms of product brands is that the dispensaries have most of the power, and they have the ability to make the brands. So for TerraSend, our first priority in, say, on the West Coast, where there's a strong wholesale market that you can stock your shelves pretty well with other people's products, my number one priority is to own retail, or that last mile relationship with the customer or the patient. And then our view is, say, with the Apothecarium, we just closed on the San Francisco portion of that transaction 3 or 4 months ago, and 97% of the products they sell are other people's products right now. Now we're looking at several brands that we could potentially roll in, but it's a win-win for us because we're valuing them based upon launching their brand in California, Nevada, Pennsylvania, New Jersey, Canada, to the rest of the world through Canada, and through our hemp CBD formulation all across the US. And a lot of these other brands, say in California, are just valuing themselves as a single state
So
operator.
there's the brand. The brand is really the dispensary, is really the national retail footprint.
Right.
And we'll see who rises out of there on an individual bottom-up basis.
Right, exactly. And then if we can go from 97% other people's stuff in our stores to 60% other people's stuff in our stores, then we can pick up a lot more margin. But I still believe that the brand that we're much more focused on is owning that dispensary footprint.
Okay, so a little bit of the philosophy on how you and how we're looking at things. We've got 3.5 minutes left here, and I want to get into a little bit about the fund itself, also how we're viewing the market and investing in this environment. I mean, market much akin to how the Jets played last night against the Patriots, not going so well. And I think, yet we've heard that, and we all believe that this is the greatest macro trade, as Kevin Murphy put it. I would also say, as someone who's been investing in new asset classes, one of the things that you can say is that you can't invest in a bad neighborhood. So that means many different things, but no matter what you do, if you're investing in either a sector or a subsector or in terms of those are going to ultimately define. I think we all believe we're investing in a good neighborhood, but the argument is it's never been a better time to be allocating capital to an industry that's now gone through what this industry has gone through. It's made it more selective, and arguably extreme valuation opportunities are where we are. So let's talk about what we're seeing in the fund and how you would now be choosing from opportunities here.
Sure. I guess the issue I think the issue with the market and the reason for the weakness over the last several months is because structurally the U.S. Operators are more difficult to invest in than the Canadian operators. Obviously, because the Canadian operators aren't operating illegally. So the U.S. operators trade at lower multiples than the Canadian operators, and what's happened is the Canadian market has not developed to the extent or at the speed of what people were predicting. So the revenue estimates and profitability estimates on the Canadian companies are going down, and when the U.S. operators just trading at a function of what the Canadian operators are trading at, it's driving the U.S. operators down as well. But the issue is, these U.S. operators, many of them are growing really, really well. I mean, these are vibrant markets that they're operating in, and right now they're just sort of, like I said, they're linked to the Canadian players. My view is that needs to de-link, because it's not, it just doesn't make any sense that these players in the U.S. that are generating substantial revenues and in many cases substantial profits are at the mercy of these Canadian operators who are operating in a much smaller market. We like to say a lot at my office, short-term the market is a voting machine. You've heard me say it a million times. Short-term the market is a voting machine, and long-term it's a weighing machine. And in my view, the U.S. operators are built right now for the weighing machine because they're generating significant revenue. They're growing significantly quicker than operators in pretty much any other jurisdiction. But right now they're being held down by the fact that the Canadian stocks are having such a tough time.
So you're referring to the public markets. I think what's interesting about our fund is it's a public-private fund. So it's a best opportunities, and I think the ability to manage money in either call it asset class is critical. Talk about that. Talk about either where there's better opportunities, public versus private. There's a lot of investors that don't have the same access to private. Yeah. And the public markets have created some cases where some companies are actually trading at a small multiple of cash. I mean, this is a very attractive time.
Right, absolutely. So we generally, most of our investments start out as private investments, and then many of them over the years have gone public. And I run a fund with, I ran for the first 15 years. My fund was all public equities. I love investing in public equities. Right. Number one rule in public stocks is hold your winners and sell your losers. And so very often when we have a private company that's gone public, we try to hold on to them for as long as we can, or for as long as they're executing. But generally, our biggest winners are ones that start out private and then become public. But we don't have to, like a lot of other companies that are structured more like private equity funds, we don't have to exit them once they become public. And some of our bigger gains have happened once they went public. Metrum was a private investment that we were, after they went public, we were flat on it for a significant amount of time. Then they were bought by Canopy Growth, and it really took off. If we weren't allowed to do publics and privates, we wouldn't have been able to
Long-term greedy has held you
gains.
in very good stead with names like Canopy and Metrum, but also there's been a time to sell those names. And again, we're talking about a hedge fund. We're talking about either having the ability to be active, to be tactical. What gave you pause this summer in a lot of these names?
I guess what gave me pause is just that overall the market was developing in Canada at a slower pace than people thought that it was going to. I think over the long term, Canada can be a great, there's great opportunity in Canada, but essentially, Canada is the size of the California market. It's one state, it's one big state. And the problem is that that Health Canada and the restrictions overall on how you can package your products and what you can do, it's really stymied companies that are trying to build brands overall in Canada.
Okay, so I've noticed that actually the clock counted down to 0 and is now moving in the opposite direction. So we're a minute and a half past our time. Thank you for listening this morning to a hedge fund approach to the sector. Thank you. Thank you.